So now we are starting to revise the introduction to income tax. So first and foremost, to develop the nation, the government needs two things: power and money. Power comes from the constitution, money can come from three sources. That is, government's own ventures or own business, taxes and borrowings. Taxes is the money charged by the government on products, income or activity to meet the common welfare expenses. Taxes can be of two types: direct tax and indirect tax. Direct tax, the example is income tax, and for indirect tax, the example is GST. Direct tax is collected directly. It means what? It is charged on income or wealth, whereas indirect tax is collected indirectly by being charged on goods or services. Direct tax, the incidence does not pass to any other person. It means that you cannot recover the direct tax from any other person, but in case of indirect tax, incidence passes to the end consumer, means you can recover the indirect tax from end consumer. Direct tax is a progressive system of taxation, whereas indirect tax is a regressive system of taxation. Progressive means the rich people are taxed more and poor are taxed less, whereas regressive means that everyone is taxed equally. Now let's come to the Constitution. The Constitution gives the power to levy taxes. However, before giving the power, the Constitution also places a restriction via Article 265. The restriction Article 265 says that no tax can be levied except by way of law. Only if there is a law, there can be a tax. Then we have Article 246, which has the 7th schedule, and the 7th schedule has three lists: union list, state list, concurrent list. Union list is list 1, which gives the power to the parliament to draft the laws, and in the union list only one of the entries is entry number 82, which says income tax on income other than agricultural income. Does it mean that agricultural income cannot be taxed at all? Answer is no, because income tax on agricultural income is given in the state list. Now let's come to the income tax law. Is Income Tax Act equal to Income Tax Law? Answer is no. Income Tax Law is a much wider term. Income Tax Act is only a component of the Income Tax Law. There are total 5 components. The first component is Income Tax Act. Income Tax Act was passed in the Parliament in the year 1961, and it came to force in 1/4/1962. The Income Tax Act has chapters, sections, schedules. Chapters is nothing but a group of sections, and schedules are nothing but the additional information that is given in the act, whereas sections are only the actual content of the Income Tax Act. There are 298 sections. It means what? Sections numbered from 1 to 298, not 298 number of sections. Now, how to read the section? A section can be read like this. First, we have to say section, then subsection, then clause and subclause. This is generally said when two subsections are linked with each other. It means what? Only if you read all the subsections together, you will get the complete meaning of the section. However, sometimes two subsections are not at all linked with each other. In such case, you cannot call them as subsections. You should directly call them as clause. We saw the example of section number 2, which gives various definitions. Hence, you have to say section 2, clause 1, section 2, clause 2, etc. Now let's come to subclause. Subclause is a subpart of a clause, and then we have provisos and explanations. Proviso generally starts from the word provided. So if the first word is provided in a paragraph, it means that paragraph is a proviso. Such paragraph gives exceptions or conditions to a particular section. Then we have explanation. Explanation gives clarification for a particular section. It gives extra meaning to a particular section, tries to define in detail what the section is trying to say. Then we have the Annual Finance Act. Annual Finance Act is passed in the Parliament every year, and in the year of election, that is Lok Sabha election or general election, it is passed twice. Okay, so in 2024 it is going to be passed twice. Hence it will be called Finance Act number 1 and Finance Act number 2. What is the purpose of this Finance Act? Every year the Finance Act is passed to amend the Income Tax Act. Amend means what? Change the Income Tax Act, and also to give the tax rates. However, can only the Finance Act change the income tax law? Answer is no. Income Tax Act can also be changed through other acts. For example, Taxation Laws Amendment Act. Then we come to income tax rules. Income tax rules are passed by CBDT, that is the Central Board of Direct Taxes, which we also call as Income Tax Department. Why does CBDT give rules? To carry out the purpose of the act. And like sections, even rules have sub-rules, clause, proviso, explanation, etc. So it is structured in the same way like how a section is structured. Now let's come to the fourth component, that is circular and notification. Circular can be passed by CBDT only. However, circular, okay, what is the purpose of circular? To clarify the doubts or to solve certain problems. However, circular gives some meaning related to the provisions. The power of the provisions is not there with the CBDT. It is there only with the government. Hence, the circulars brought by CBDT are binding only on CBDT. It means what? Only for CBDT it is compulsory to follow the circulars, since it is only giving the circulars. However, for assessee it is not binding. It means what? It is not compulsory for us to follow the circulars. We can take benefit of the advantageous circulars. Now let's come to notification. Notification can be passed by central government as well as CBDT. What is the purpose of notification? Central government passes notification to implement the provisions of the act, whereas CBDT passes notification to make the rules or to amend the rules. And notification is binding on everybody. Everyone has to compulsorily follow whatever is given in the notification. Then last leg is decision by courts. If Supreme Court gives a decision, then that decision is not only applicable to the person who are fighting in the Supreme Court, it is also applicable to the entire nation, India. Okay, and hence Supreme Court decisions are also called as law of the land. Then High Court decisions are applicable not only to the people who are fighting in the High Court, it is also applicable to the respective state. For example, Madras High Court decision are applicable to all the people who are in the Tamil Nadu jurisdiction. Now, these are the components of income tax law. Now let's come to the steps to calculate the total income and taxes. I told you, first and foremost, we have to determine what type of a person the assessee is, whether the assessee is an individual or HUF or partnership firm, AOP, BOI, AJP, company, cooperative society, etc. Then, based on the person, we have to find out the residential status, whether the assessee is a resident, ordinarily resident, resident not ordinarily resident, or a non-resident. Because for a resident ordinarily resident, global income is taxable. Wherever you earn the income, it will be taxable in India. For a resident not ordinarily resident, income other than income from foreign source is taxable, and for a non-resident, only Indian income is taxable. Now, based on whatever income is taxable in India, you have to split all the incomes into 5 heads of income. First head of income is salary, second, house property, third one, profit and gains of business or profession, fourth, capital gains, and fifth one is income from other sources. Now, I told you that in Income Tax Act, the concept of income is of net income and not gross income. Hence, you have the benefit to reduce the deductions and claim the exemptions. What is deduction? What is exemption? Deduction is nothing but an expense that is allowed against the income. However, exemptions are the incomes that are not taxable under the Income Tax Act. After all this, if at all the income of some other person is taxable in the hands of assessee, that income should be clubbed in the hands of assessee. And then if at all there is any loss, then you have to see whether you can set off the loss or carry forward such loss. After doing all these adjustment, you will get gross total income. From this gross total income, you can further reduce the deductions that are given under chapter 6A. After this, you will get total income, and you have to round off the total income to the nearest multiple of 10. After this rounding off, you have to apply the tax rates. Now, the tax rates can be of two types. First is normal tax rates, second is special tax rates. Special tax rates are specific rates for some special types of income which is given in different sections. We have already covered one special tax rate, that is undisclosed source of income. Now what about normal tax rates? Normal tax rates can be of two types. One is the default tax regime under section 115 BAC, and second one is the normal provisions. Default tax regime is nothing but a new tax regime which is given under section 115 BAC, where the tax rates are less. However, exemptions and deductions are also less. Similarly, in normal tax provision, it means what? The usual regular income tax act provisions, there the tax rates are a little higher, but you get the benefit of more exemptions and deductions. So after applying the tax rates, you have to give the adjustment of surcharge, marginal relief and 87A rebate as applicable. After that, add the health and education cess, which is always 4%. You will get the total tax. From the total tax, you should further reduce taxes that you have already paid in advance, that is advance tax, TDS and TCS. Finally, you will get the final tax, that is payable or refundable. And this final tax also, you have to round off to the nearest multiple of 10. Finally, with all this information, you have to file your income tax return. Fine. So this is the introduction. Now let's come to the basic concepts. We are going to revise the basic concepts chapter in the income tax law. First and foremost, we are going to discuss section number 4. Section number 4 speaks about levy. Income tax is levied on. It means what? Income tax act is applicable on. Applicable on what? Total income of the previous year of every person. Total income of previous year of every person. When it comes to total income, let us discuss a few concepts. First and foremost, income concept. As per the Income Tax Act, income can be regular income also, casual income also. It means what? If you get an income regularly over a period of time regularly, then it's a regular income. Casual income means an income that you are only getting once in a while. For example, you won a lottery and got an income. That is a casual income. In Income Tax Act, both types of incomes are taxable. Then, whether income refers to net income or gross receipts, answer is it refers to net income. It means what? After the gross income, you can reduce the deduction. However, the deductions that you reduce should be as per the Income Tax Act. Then, whether income is taxed on due basis or receipt basis, answer is it changes based on the income or the head of income. Then, capital receipt versus revenue receipt. Why are we learning the difference, sir? Because capital receipt is not at all taxable unless it is mentioned specifically under the Income Tax Act. However, revenue receipts are always taxable unless they are exempt from the Income Tax Act. Then, capital receipt comes from fixed capital, revenue receipt comes from circulating capital. Capital receipt comes from the transfer of capital asset. So if you sell a capital asset and if you get the money, that money will be called capital receipt. Whereas revenue receipt comes from trading assets. For example, stock, you trade stocks. So when you sell the stock and get the money, that money will be called revenue receipt. Capital receipt comes because of the source of income. For example, if you have a house source is the source of income of rent. If you sell the house itself and get the money, then it will be called as capital receipt. However, revenue receipt does not directly come from the source of income. It is the income from the source. Example, rent from the house. Then capital receipt arises not due to the ordinary course of business. Revenue receipts arise due to the ordinary course of business. Then if you have a purchase, if you do a purchase not with the intention to resell, if you do not have any intention to resell, but still later on you sell that particular goods and you get the money, then it is called capital receipt. However, if you are having an intention to resell and then you are selling it, then the money received will be called revenue receipt. Then in case of shares, if the shares are acquired and sold as an investor, then it will be called as capital receipt. However, if shares are acquired and sold as a dealer, it will be called revenue receipt. Exception, foreign institutional investors, which we will learn in capital gain chapter. Then example for capital receipts: gift, liquidated damages and compensation on termination of employment. And in case of revenue receipt, sale of stock, receiving rent, receiving interest on loan, receiving salary, etc. All these are examples of revenue receipts. So this is the income concept. Now let's come to the previous year concept. To know more about previous year, firstly you should know the difference between financial year, previous year and assessment year. Financial year means a year starting from 1/4 to 31/3. Okay. Then what is assessment year? Assessment year is a financial year. But what is special about this financial year? It is the year in which the income is taxed or income is assessed. It is always from 1/4 to 31/3, always 12 months. When it comes to previous year is defined under section 3 of the Income Tax Act. Previous year is called the previous year because it is the financial year immediately preceding the assessment year. That is why it is called previous year. It is the year in which the income is earned. Generally, previous year is also from 1st of April to 31st of March. However, in case of a new business or profession, previous year is from the date of setting up of the business or profession till 31st of March. In case of a new source of income, previous year is the date on which the source of income comes into existence till 31st of March. So that is the previous year meaning. Now let's come to previous year for undisclosed sources of income. Sir, what is this undisclosed source of income? Undisclosed source of income means that there is an income which is not disclosed by the assessee, or it is not shown by the assessee in the income tax return or the books of accounts, as the case may be. In such case, what will happen? If there is an undisclosed income which is found out by the assessing officer will ask for explanation. If assessee is able to give satisfactory explanation, then the case will be closed. However, if the assessee is not giving an explanation or not able to give any satisfactory explanation, then assessing officer will treat the income as undisclosed source of income. If the income is treated as undisclosed source, then it is taxed under section 115 BBE. What is the tax rate? 60% tax plus 25% surcharge plus 4% health and education cess. Effectively, it is coming to 78%. And moreover, against this 115 BBE income, that is undisclosed source of income, you cannot adjust the basic exemption limit of 2,50,000, 3 lakhs or 5 lakhs, as the case may be. That you cannot adjust. You cannot claim any deductions against such income. You cannot set off any loss against such income also. You get my point? Now let's come to what are the different types of undisclosed source of income. Number 1, section 68, that speaks about cash credits. Cash credit means a sum that is credited in the books of accounts. So if the assessing officer finds any credit in the books of accounts, he will ask the reason for the credit. If satisfactory explanation is not given or no explanation is given, it will be treated as undisclosed source. Then we saw special points relating to cash credit. What is the special point? If cash credit is in the form of a loan or borrowing, okay, from a person, then assessing officer will not only ask the assessee assessing officer will also ask the person who gave the loan, from where did you get the money to give this loan? That person who gave the loan should also give satisfactory explanation. If both are not giving satisfactory explanation, or even if anyone is not able to give satisfactory explanation, this cash credit will be treated as undisclosed source of income in the hands of assessee. Then when it comes to share capital, share application money, share premium, or any such amount, there also where the assessing officer will ask the assessee will explain. Assessing officer will also ask the person who has given this share capital, they should also explain. If both are not able to explain, then it will be treated as undisclosed source of income. However, there is an exception. What is the exception? If the share capital or share application or share premium is given by a venture capital fund or a venture capital company that is registered by SEBI, then assessing officer need not ask them about explanation. So this is cash credit. Then let's come to section number 69. Unexplained investment. Unexplained investment means what? Assessee has made an investment. For example, he has purchased shares. He has bought a house. Such investment is not disclosed in the books of accounts. In such case, assessing officer will ask for the reason. If no satisfactory explanation is given, it will be treated as undisclosed source of income in the financial year in which the investment is made. Next, section 69A. Unexplained money, bullion, jewelry, or any other valuable article or thing, where bullion is nothing but precious metals. If they are not recorded in books of accounts, assessing officer will ask for explanation. If no explanation is given, it will be treated as undisclosed income in the year in which the assessing officer finds out. Okay. Next, section 69B. Section 69B talks about investment, money, bullion, jewelry, or any other valuable article or thing whose value exceeds the amount recorded in the books of accounts. It means what? In the books of accounts, value is less, but in real life, the value is more. If the assessing officer finds out, he will ask for reason. If satisfactory explanation is not given, then the difference between the value, it means what? Difference between actual value and book value will be treated as undisclosed source of income in the financial year in which it is found. Next, section 69C, unexplained expenditure. Assessee has made an expenditure which is not there in the books of accounts. Assessing officer will ask for the reason, where did you get the money to do this expense? If he is not able to give satisfactory explanation, this unexplained expenditure will be treated as undisclosed source of income, and against such income, no other expense will be allowed as deduction. Then section 69D, amount borrowed or repaid on hundi. What is hundi? I told you, hundi is nothing but like a bill of exchange or bill discounting transaction, but without involving the bank. Okay, the individuals are the people who do hundi transactions. If there is a borrowing or repayment that is made on hundi, then it should be it should only be through account payee check. If it is other than account payee check, then the entire amount of borrowing or repayment will be treated as undisclosed source. However, one small point, what is that? If one time the hundi transaction is already made as undisclosed source, again on the repayment, it will not be made as undisclosed source, because one income can be taxed only one time. It will not be taxed two times. So this is undisclosed source. Now, income of previous year taxed in the previous year itself. It means what? Need not wait till the next year, assessment year. In this case, previous year and assessment year will be the same. There are 5 cases where income of previous year is taxed in the previous year itself. Number 1, section 172, non-resident shipping business. So if a non-resident is having a shipping business, in such case, the freight of the shipping business will be treated as income. 7.5% of the freight will be taxable. On this you have to calculate the tax. So 7.5% is not the tax kana, it is the income. On that income only you have to calculate the tax. And this taxability is compulsory in nature. It means what? Non-resident shipping business compulsorily have to follow this method. They do not have any other method. Then section 174, person leaving India during the previous year or shortly after the previous year. It means what? Next year, April 1st week liye, they will leave, like that, with no intention to return back. In such case, assessing officer is having the discretion or the option to go to this person and tax the income of the year till his probable date of departure. Next, section 174A, association of person, body of individual or artificial juridical person which is formed for a specific purpose. If it is formed for a specific purpose, then assessing officer has the power to come to that association of person, body of individual and AJP and tax the income of the year till their date of dissolution in the same year itself. Next, section 175. If a person is likely to sell, transfer, dispose or part with any asset or property just to avoid the tax, an assessing officer gets to know, then he is having the power to tax that income in the same year itself. Next, section 176, discontinued business. If business itself is discontinued, then assessing officer is having the power to tax the income of the year till the date of discontinuance in the same year itself. So this was the previous year concept. Now we are coming to the detailed concept about person. To know more about person, firstly we should know what is assessment, what is assessee. Assessment means what? Section 2 clause 8 defines assessment as the procedure of determining income by the assessing officer. Assessment can be normal assessment, it can be reassessment. Reassessment means what? Already the assessment is done, but once again it is reopened and assessment is done once again. This assessment procedure is a part of your CA final syllabus. Then section 2 clause 7 defines what is assessee. Very important. Who is assessee? Assessee is a person by whom any tax or any other sum is payable. So the person who is liable to pay tax is the assessee. Other than such person, who and all are assessee? Number 1, proceeding initiated for the assessment of his income or income of other person in respect of whom he is taxable, his loss or such other person's loss, his refund or such other person's refund. So it means what? If proceeding is initiated or any action is initiated by the department, such person against whom that action is initiated will also become assessee. Then deemed assessee is also assessee. Deemed assessee in default will also be assessee. So 4 types of assessee. First one, the tax or any other sum is payable. Second, proceeding is initiated. Third, deemed assessee. Fourth, deemed assessee in default. Then now let's come to person definition. Very important. Section 2 clause 31 defines who and all are included in the definition of person. So person includes individual, Hindu undivided family, partnership firm including limited liability partnership, company, association of person or body of individual, local authority and artificial juridical person. Now one time I want you to repeat all the 7 points. Individual, Hindu undivided family, partnership firm including LLP, company, association of person body of individual, local authority and artificial juridical person. Okay. Now let us see who is individual. Individual means a natural person. It means what? Human beings. If an individual is a minor, then assessment of such minor is done on the guardian. If individual is of unsound mind, the assessment is done on the manager. If individual is no more or he is deceased, then the assessment is done on the legal representative of such individual. Now let's come to Hindu undivided family. Hindu undivided family is formed because of Hindu law. What is HUF? As per Hindu law, HUF is all males lineally descended from a common ancestor including wife and daughter. Hence, only the Indian origin religion, the people who follow Indian origin religions can form a HUF. That is Hindus, Jains, Buddhists and Sikhs. Other than these religions, the other people cannot form Hindu undivided family. Or if they are already in Indian origin religion and they convert to a non-Indian origin religion, they will be out of the Hindu undivided family. In the Hindu undivided family, there are three types of members. One is Karta. Karta means what? Head of the family. Then comes co-partners. Co-partners are the members who are having the right to partition in the family or right of property in the family. Then the other members will only be called members. Such members have what rights? They have only the benefit of the expenses by the Hindu undivided family. That is expense relating to food, relating to clothing, etc. etc. Earlier, daughters could not be a part of HUF. However, from 6th of September 2005, even daughters can be a part of a co-partner in the Hindu undivided family. Then, wife and daughter-in-law cannot be co-partners. Daughter can be co-partners. Wife and daughter-in-law cannot be co-partners. Why they cannot be co-partners? Because they are co-partners in their parents' property. Now let's come to School of Hindu Law. There are two schools of Hindu law. Dayabhaga school, Mitakshara school. Dayabhaga school is prevalent in West Bengal and Assam, whereas Mitakshara school is prevalent in the rest of India. Dayabhaga school, no right of property is received till the head of the family dies. Hence, only the father and brothers of father will be co-partners since the grandfather is no more. Okay? If father also dies, then only the children of the father will get the right in the property. But in Mitakshara school, right is by birth and not by succession. Hence, even children will be co-partners in the property. Now let's come to company. Company, very, very important to know all the meanings of company, domestic company, foreign company, Indian company, etc. Because we have to differentiate it properly to know what and all companies are covered in which category. First and foremost, section 2 clause 17 defines what is a company. As per the company definition, number 1, an Indian company defined under section 2 clause 26 is a company. Number 2, a body corporate under any other law will be considered as a company. For example, a company formed under US laws. Example, Meta Incorporation is also a company as per the Income Tax Act. Number 3, a organization assessed as a company under the Income Tax Act 1922 before 1/4/1970, they will be called company. And lastly, whether an organization is incorporated or not, whether it is Indian or not, if CBDT is declaring that organization as a company, it will be coming under company. Now let's come to what are the different classes of companies. Companies can be of two classes, domestic company, foreign company. Foreign company is defined under section 2 clause 23A of the Income Tax Act, and foreign company means not a domestic company. So what is domestic company? Domestic company is defined under section 2 clause 22A of the Income Tax Act. Domestic company means number 1, Indian company or company which has made arrangement to declare and pay dividend in India out of the income taxable in India. Then what is Indian company? Indian company is defined under section 2 clause 26. An Indian company means a company that is registered under the Companies Act 1956 or 2013 and having registered office in India. Fine. So Indian company means what? Registered under Companies Act 1956 or 2013 and having registered office in India. Apart from this, Indian company also includes the organization that is declared by CBDT as Indian company, and other than that also, if the central government or state government or union territory is forming any company under their laws, those will also be called as companies. And I told you, State Road Transport Corporation, State Financial Corporation is also company. Now let's come to section 2 clause 23, which defines firm. Firm includes limited liability partnership. The definition of partnership firm should be taken from the Partnership Act 1932 and definition of LLP should be taken from the LLP Act 2008. So same definition as per the respective act. However, in income tax, minor will be considered as a partner if minor is admitted only for the benefits of the partnership firm. Now let's discuss the difference between association of person and body of individual. First and foremost, you should know that if at all there is a partnership firm, it will be coming in the firm category. It can never be AOP or BOI. Purida. So partnership firm under Partnership Act or LLP Act will be considered as firm. It will not be considered as AOP BOI. Then other than partnership firm, whatever the other groups are there, no, those groups only will be considered as AOP or BOI. AOP, association of person, BOI, body of individual. From the name itself, we know that only individuals can form BOI, that is body of individuals, whereas other than individual also can form what? Association of person. That is the first difference. What is the second difference? In case you find a group of individuals, the group of individuals can be AOP also, BOI also. Then what is difference? In case of AOP, the group comes together for a common purpose to produce the income. They will earn the income and they only have the rights to the income. However, in case of body of individual, they merely receive the income, but they do not have the rights to use the income. For example, executors and trustees are body of individual. Executors and trustees will merely receive money. Okay, so executors will receive the money for the legal heirs and trustees will receive the money to give as donation. They cannot use that money for themselves. They can only receive and manage that money. Whereas in association of person, there are three examples: co-heirs, co-legatees and co-donees. So co-heirs, co-legatees as well as co-donees can use the income that is given to them. Next, explanation to section 2 clause 31 tells that AOP BOI will be considered as a person even if they do not have the intention or if they are not formed for earning an income. So if there is a group of persons, it is not necessary that they should have intention to earn income. Even if they are not having intention, such group can be called as AOP or BOI. Next, local authority. Local authority, I gave you an example, Coimbatore Municipal Corporation. It means an authority which is in control of a municipal or local fund. If the municipal authority or local authority is supplying in its own jurisdiction, then no need to pay the income tax on the income. However, if it is supplying outside the jurisdiction, then income tax is levied on the income. However, if the income is because of water and electricity, no need to tax that income. Lastly, artificial juridical person. Artificial juridical person is a residuary head. It means what? In the previous 6 heads, if a person is not falling in under those categories, then the person will automatically fall under artificial juridical person. Example, idol, statues, deities, universities and bar council. Now comes the question whether central government and state government are persons. Central government and state governments will not be considered that as persons because in the 6th point, local authority is specifically mentioned. Since it is specifically mentioned, it means what? The act is purposely trying to exclude central government and state government. That is why they are not persons. Fine. With this, we have finished the basic concept chapter also.